Hey, Paul, Mauro here. Smart Financial, welcome back. Thanks for subscribing to the channel. Keep in touch with us about the webinars that we're having. I have a really great topic today, which is going to save you about $300,000 in the next 10 minutes. So if you want to save about $300,000 in the next 10 minutes, just listen up. I know it's going to be some numbers, might get a little boring, but this is really important. There's a huge firm that does analysis of mutual funds and performance. It's called Morningstar. So I don't need to do a commercial for them. They're a wonderful firm. They compile data. They're just data people. And occasionally they'll take the data and then they will issue reports on what they think the data means. I have to read their recent headline to you, and then we'll talk about it together on the other side. Okay, ready? They say bonds may be losing money, but there's a bright side. Now, I will tell you, I have never found a bright side to losing money. Now, for those of you that are out there that like to lose money, you can probably stop listening now. But for those of you that are out there that have owned bonds and bond funds the last 5 years, you've lost some money. So let me just put this in perspective. This is a part of the talk that we gave a while ago about smart financial portfolio building, which, by the way, is a part of what's in my first book, Smart Financial Grandparenting, and the second book, which is just coming out this month on smart financial longevity planning. Bonds aren't really a factor in my third book about wealth building, because really for young people, it's all about equities, it's all about business, and it's all about building wealth. Bonds are a fixed income product designed to protect wealth or balance your portfolio. So let's just give you an explanation. And then for those of you that happen to be either boomers or ex-geners that are in your 60s, this will have some meaning to you. If you get to 60 and you have a balanced portfolio, and you're trying to not bet it on the red, preserve your money, take a little less risk, to have some moderate portfolio performance, you may actually have what's called a balanced fund portfolio. Or if you have an individual registered investment advisor, they might have built you your own balanced portfolio, 50% equities and 50% bonds. Now, here's my story about that. If you put your money into the Vanguard bond fund, which again, I love Vanguard and I can't say anything bad about them. This is not a knock on Vanguard. It is actually a knock on the generic bond category, right? And if you bought their Vanguard bond fund, you can look up, it's called BND. You don't need me to tell you all about how great that bond fund is and how it's got low expenses. However, if you own that bond fund as a part of your portfolio the last 5 years, you had the pleasure of losing 15%. All right, so let's go back to our semi-retired, almost retired ex-gener or boomer who's got $2 million and $1 million of it is sitting in the bond fund. Well, it's not $1 million anymore. Now it's $850,000 because it went down 15%. Now, I don't find a bright side to that. Morningstar might find some bright side to that. I don't. Especially in this day and age when there's so many smart financial alternatives. If you want to balance your portfolio, I happen to come down on the same side of this discussion as Robert Ibbotson at Yale, Moshe Milevsky at Turner University, and every other writer and academic who writes about money. In 2025, there really is nothing a bond fund can do that's unique that set rate or fixed annuities can't do. Now, when I say a set rate or a fixed rate, a 1, 3, 5, 7-year term, short-term, fixed, 100% guaranteed annuity. The only thing that annuity cannot do is lose money like a bond fund, okay? So here we go. Let's just compare the same results over the last 5 years for those people who took their portfolio and they put half in equities and their investment advisor is doing a great job on that. And the other half of their portfolio, $1 million, they put in for 5 years at 5%. Guess what? They made $50,000 a year, and now that bond portfolio, which has been rolled into this fixed set rate annuity contract, is $1.2 million, not $850,000. It's a huge spread. It's a 40% difference. Now, I will tell you, I don't work for an annuity company. We've recommended them for years. Most of you that have been following me, I ran a financial practice for 50 years. Most of our balanced customers, our balanced clients, they had a portion of their fixed income in guaranteed annuities. Why? Here's the 4 reasons, ready? Number 1, you don't pay a fee to buy them. That means there's no fee going in. Number 2, the only fee is if you cancel early, just like a CD or something over a 5 or 6, whatever term you pick. If you cancel early, you would expect to pay a fee, okay? Now, the third thing is the principal is guaranteed and the interest is guaranteed. There are no moving parts. These things used to be called all different names, but they're currently called set rate or fixed rate. They used to be called guaranteed investment contracts, GICs. There's no moving parts here. There's no annual fee. There's nothing. It's like plain vanilla, just money. You put the money in there, it earns a fixed rate of interest. At the end of the term, you can take the money out. You can even take the interest every year if you want to spend it. That's great. But number one, you can't lose your money. And number two, you do not pay management fees. So when I say I can save you $300,000 on this balanced portfolio, in the first sense, you'll make $250,000 just by parking the money at 5%. Now, I know rates today are actually 6%. Rates have gone up, and if you did a 5-year fixed rate contract, you might get 6% instead of 5 years ago, whatever. Okay, whatever the rates are, they're afloat with the market. So right now, that rate for the next 5 years is 6%. Okay, the big part of this is you don't pay 1% management fee on that. You pay a 1% management fee on your equities. And I love financial advisors. I've been in this industry a long time. They work hard, especially in equities. They deserve the fees they make. In fact, I think in some cases the fees they charge are too low. That's a topic of another whole video. But I will tell you that if you have a balanced portfolio with an advisor that's really working for you, they will do everything they can to keep your fees down by taking a portion of that portfolio and putting it into a zero fee, fixed and guaranteed interest contract. So instead of paying 1% on $2 million, which is 20 grand a year, okay, it's 1% on $1 million, which is 10,000 a year. You would save $50,000 in just 5 years. Now let's go forward. For a real life retiree example, you're talking 20 years, from 60 to 80, saving $10,000 a year. That's a lot of money. Even where I come from, that's a lot of money. And for a lot of you that are listening to this, that's 200 grand of savings in fees alone. And I'm not saying paying fees is bad. I actually, again, we like advisors. There's a lot of advisors that are associated with us at Smart Financial that do this kind of planning, which is saving fees for clients, protecting their portfolio. And I don't understand why anybody would pay a 1% management fee on a 30-year bond that's going to sit there in their portfolio, attempting to give them balanced protection. Really, in this day and age, in 2025, that's like having a car with roll-up windows. It's like having an air conditioner huffing and puffing hanging out of your upstairs window. This is old technology, all right? The modern product build from quality companies, by the way. Now, I'm not talking to those of you who buy junk bonds. If somebody's going to go out and buy a bond, you know, they're rated A, B, C, D, and some folks like the speculation of buying a Q-rated bond with lousy financials because they have to pay more interest because they're going to go out of business. Okay, fine. If you're a junk bond buyer, that's a whole different topic. But if you're the kind of buyer that buys AAA, AA, A+ rated, that's exactly the kind of rating that you would buy on your annuity contract. You would only buy, and I suggest you only buy, whether you do it with a firm that we know or somebody else, right? I wouldn't put your name to a piece of paper that didn't have more net worth than you do. So you have to look at what's called a COMDEX, C-O-M-D-E-X, COMDEX, which is a combination of all the rating services, S&P, Moody's, Weiss, etc. So you want a highly rated company for that fixed term, okay? And by the way, most of these contracts, again, they can be written in 1 year, 3 year, 5 year, 7 year. I would do it before rates go down, and I would tell you why. You're going to feel very smart. If you locked in a 6% rate for the next 5 years, and in 2 years, the Fed lowers the rate and they go down to 3 or 4%. I would say that grabbing high interest rate locks now for this type of a product is super smart. So they're called fixed rate, set rate, no moving parts, no annual fees. The best thing about them is they don't know how to lose money. This is Paul Mauro, and I'm here at Smart Financial trying to help you save $300,000 today in the last 10 minutes. And if you get on the website or you like us on Facebook, the next 20 people that do that, we will send you a free copy of either Smart Financial Grandparenting or Smart Financial Longevity Planning. And if you want to wait for the new book coming out on Smart Financial Wealth Building, you can have that too. Take your choice. Do the smart thing. Read up, get educated. It's just the art of being smart.